Mhm. Hello, very good evening to everybody. Well, let me just share my screen first before I start. Hmm. Okay, for those of you who are joining us for the first time, I'm Billy To. I'm the Regional Head of Retail Research at CGS International. So this webinar is basically a webinar for all our ASEAN Investment Challenge participants. This is held across, I think, Singapore, Malaysia, Indonesia, Thailand, and Philippines. So we have our participants from various countries. So today's topic will be on how not to go broke, right? The rules of risk. I think basically I wanted to focus a bit on defensive today. For those of you who do not know me, I have an experience in the investment industry for over 10 years, been covering various markets in Malaysia, Thailand, Philippines back when I was at IHB as an economist. I also look at the US market as well as the Singapore market today. So I do have a bit of a background in terms of the region. I think the only market that I don't have exposure in is in Indonesia. So if you do have any questions on Indonesia, and if I can't answer, I will revert back to you shortly after we discuss with our analysts. All right, let me just share the screen on full screen first. Okay, great. How not to go broke, the rules of risk. So I guess a lot of times we fail to understand one thing, that a lot of people look at investing as a fast way to make money, but it's really a market is really a device that helps to transfer money from the impatient to the patient. This is a quote from the famous Warren Buffett. All right. Right, this is just a disclaimer. The webinar today is basically on education and awareness purpose. So it's not basically an investment advice per se. You probably need to look at your whole portfolio as a whole before you decide whether the investment is suitable for you or not. I think I'll address some of these issues as we talk about managing risk later on. All right, are we ready for more? So let's just get started. All right, I guess just a quick recap of what we've gone through last week. I think we busted one of the biggest myths about money. I think a lot of people think of investment as something for the rich, but I think what we've talked about last week, we really emphasize and address is that it's not about being rich to invest, it's about investing in order to be rich. So the idea of allowing money to do the extra work so that you can generate money on a passive income without having to work 24 hours all the time, right? So I think the quote of the day is similar to what I started on. And today's focus is how not to go broke. I think there will be a lot more on defensive today. It's about staying in the game, not just winning it once. So we will explore a few things. Some of the key things that we will be talking on and focusing on is to avoid emotional traps. We will also talk about how to manage risk smartly, and of course, to build a solid defense with diversification and mindset. Right, let me just okay, here's a bit of pulse check. I think how I started off last week was I asked you guys to really look at some of the how you guys have been looking into the stock market, whether you've been investing or not. So for today, it's on the defensive side. So we'll talk about some of the biggest fear that you have when it comes to investing. So are you afraid of losing all the money? Or are you not knowing when to buy or sell? Do you make the wrong choices? Is that what you're afraid of, or are you afraid of missing out when others are making money? So you have to be honest with yourself when you ask this kind of questions. So have you, for example, have you ever bought a stock just because everyone else was talking about it, right? So if it is, then yes, FOMO is likely real for you. Some of you might be just occasionally, depending on what the stock is. Some of you probably never. You probably are someone who like to look at your own research. And I think the third option should always be the option that we opt for. All right, the first chapter, the first topic that we will talk about today is the harsh truth. I think a lot of people look at investing as making money, trying not to lose out. But the harsh truth is this: the market is a cycle, so it gives sometimes, but occasionally it will also takes. This is a reality check for everyone. It's a roller coaster, right? It's a cycle that no one can escape. Let's put it this way. And market cycles are natural. What goes up will eventually come down. So the key is really to stay in the game when others are knocked out, is to stay in the game as long as possible. I think we talked about that last week as well. The time in the market is more important than timing the market, meaning that you need to stay in the market as long as possible. And in the long term, between 5 to 10 years, most likely the case is that the market will be on an uptrend. So we are looking at these two cases here, the bull market and the bear market, just to look at the key differences. When I talk about bull market, a lot of people focus will be a lot on optimism. So sometimes there will be greed. And then, of course, what we see is rising prices. So there will be that FOMO, the fear of missing out will dominate among a lot of us when we talk about, for example, I'm sure you will if you have been investing, you have friends asking you, have you buy Nvidia? Did you buy Nvidia? Did you buy this AI stocks, for example, right? I think during the COVID period, I think at one point everyone was talking about GameStop. So that's also FOMO. Everyone is just talking about the latest hot stocks that are in the market, right? And it's easy to look genius, like a genius. It's easy to look smart in a bull market because almost everything goes up. So most people will make money in a bull market, and most people will find that, will probably have an illusion that they are very good at trading or investing. So this is some of the dangers that we need to look into as we progress along, right? Now, of course, the bear market is when panic, and there's a lot of fear, especially when market collapse. For example, I think again back in COVID, I think when initially the announcement of all the halt in all the economic activities, the market actually tanked about close to 30% in just a matter of weeks. So that's a lot of panic, a lot of fear. People were very afraid, right? So risk aversion will dominate at that point. Just now in the bull market, it's always FOMO. When it's the bear market, a lot of people talk about risk, and they say, I just want to wait, and I just want to wait until the right time to buy into the market. So that's usually what happens. So it's very hard for people to stay invested in a bear market because you are always hearing a lot of bad news. And if you look at the news, if you look at your papers, there will always be headlines that will scare, that will be very I think the idea is that the headline will be very clickbaity. You'll put you into a position that you'll make certain decision that you otherwise not make if you're thinking it rationally. All right, so just look at this image. So if you look at it, is there's always a greed and always a fear factor when you're trading the market. So we need to learn to address that when you talk about risk. Right, so here are some of the famous market shakes up that we have seen over the last few years, right, when risk hits really hard. So I'm just going to address a few. There are actually a lot. I know I'm not going to talk about the Black Monday and the others, which is way before our time as well. But I'm just going to address some of the more recent ones. So for example, GameStop in 2021, there's a lot of retail frenzy. People go into Reddit to talk about investing. I think even today, a lot of people jump into social media to talk about investing. What's the latest stock to buy? I think if you read top 5 penny stocks to buy and things like that, that get people's attention, right? So there's a lot of interest in this kind of thing. And when a lot of people, while make money, there are a lot of them that actually lost money and lost big because they buy at the top, right? Even when you would invest in an earlier period, a lot of time actually people do invest it when it goes at a higher level. So it's basically that fear factor that drives you to keep buying, even though when prices are at a level that is a bit extreme, right? Then there's also the dot-com crash. Is between the 2000 2002 area, right? The tech stocks soared on future hype. If you know about or anything that's internet related will go up. Sounds familiar, right? Today, anything that is AI related, if you look at all the earnings, every company just throw in an AI words into their earnings guidance, etc. Right? So that's basically the case, right? But during the dot-com crash, the Nasdaq fell more than 50% from its peak. I think it was close to 70 or 80%, right? But the risk was really because a lot of them are chasing unproven growth with no earnings. So I did not have that headline here today with me, but one of the headlines at that time was that earnings are no longer matter, right? It's no longer important because back then it's always about potential, but growth potential. So when the market crash, that's when you see the news here. They talk about the year .com turned into a dot bomb, right? So again, I just want to highlight this to you so that you know how some of the headlines can be a bit exaggerating. So you probably need to look beyond all these headlines in order for you to make a good decision, right? Then of course there's always the COVID panic. I talked about that earlier just now. So the risk is that you will sell at the bottom, or when you will stay paralyzed, you'll be too afraid to make any decision, right? So that's some of the incidents that we've learned from previous or recent market crash, right? So why this matters? Why is this important for you? Whether it's for this competition or whether it's for your own investment, right? Because even the best strategy needs protection. We just look at some of the few people that I mentioned here. For example, Warren Buffett, he's done very well over the last more than 30, 40, 50 years. But if you look at even for someone like him, during the global financial crisis, he lost money, although it's just temporarily, because that's what happened when the market crashed. It's a cycle, right? So another well-known investors, Katie Wood, she did very well in the early stages in 2021, but then crashed in 2022. It was very much in line with during when Tesla sees a sharp decline in their share prices, which I'll talk about later, right? So buy and hold fails will fail when you don't have a strong mindset and if you don't know how to limit your risk, right? So I'll just give you an example why this is very important is this. If you look at this, let's say you start your investment with $1,000, right? If you lose 50% of your initial capital, right, you left with 500, right? So in order to make back that 1,000, right, you need to double your return, meaning that you need to earn a return of 100% on top of that $500. So your return need to double in order for you to just break even. So every time you lose 20%, you need to make at least 40% of the decline value in order to break even. So that's why it's important for you to manage your downside risk, because losses will compound as well. It will also accumulate, it will also eat into your investment. So you need to manage that risk, right? All right, so here are some of the common ways that investors go broke or make mistakes, right? I think I saw questions on, yeah, I think if you wanted the slide, feel free to just send us an email. I think I'll get our team to forward the slide to you guys, right? So yeah, just some of the common ways that investors actually will struggle to make money in their investment portfolio. So I'm just going to mention this four. If you look at the last one is in red, I'll highlight it for you why. So a lot of time people chase hot tips, right? So if you hear people say something about, this stocks is going to do well because the earnings is coming out, So if it's viral, it's probably too late most of the time. So try not to chase all these hot tips that you're seeing, because a lot of times, a lot of this would have been priced into the market, because we are living in a very efficient market time, because we have internet, we have social media, we have a lot of communications. So a lot of institutional investors, foreign funds, or your local insti funds, all of them will have a lot of information that you're already hearing about. So a lot of this information would have already been in the market and would have already been priced in. So if it's already viral, most of the time it's already too late. Some people go all in. I think some people are too confident. They felt that they're going to make it right. Like I said, especially in a bull market, sometimes you felt that you are God, because every time you buy a stock, it just go up, right? So it makes you feel unbeatable, unstoppable. So that's when risk comes in. So when you go all in, that means you don't have a backup plan. You don't have a risk management. So high risk does not necessarily translate into high reward, especially when it comes to investing, especially if you are going all into a single particular stocks or a single company or a single asset, for example. The next one is over trading or revenge trading. I think a lot of times people look at investing as trying to beat other people. Like when they talk about investing in the market, you look at yourself earning 10%, you saw your friends earning 50% or 100% on crypto. So you think it's not good enough. So you wanted to outperform your friends, right? So there's always that tendency to do so when it comes to investing. So the idea is really, when you're investing, is not to really compete with the market or your peers or your friends or your other people that you're talking to, because everyone have a different risk appetite. That's one thing. Everyone starts at a different point. Everyone have a different cash flow or different asset to manage. So always look at yourself, how you want to manage your fund based on where your situation is. So you're always competing with yourself. And I think the fourth one, which I addressed earlier, which is where you ignore your personal cash flow. So if you cannot handle a rainy day, right, you can't walk into a storm. So basically, you need to make sure that you have a certain savings or certain emergency funds before you go all in, or before you take on extra risk, right? So I think if you look at all these four, goes back to one key reason, which is emotional decision making, right? So a lot of time we make bad decisions because of fear and greed. So these two are the worst financial advisors that we can have. So whenever you invest, you need to make sure that you are not dictated by these two emotions. So there are a few ways to really try to mitigate or reduce the influence of these emotions, right? Which I'll talk about it later on. And then, of course, here are some of the psychology of the FOMO that you will see as we go through this. So why do we get sucked in, right? I guess, again, it's like I talk about the fear and greed. The two of it is basically the key drivers of it. But what are the key emotional triggers that you can pay attention to? So I guess in our days, it's usually the social media hype. I think a lot of people are just, I think because of all the short TikTok videos and Facebook or Reels, and that you're just so caught up in and seeing, oh, people is making money, right? Why am I not making money? So I think that's where the tendency on people taking extra risks without really going through a proper investment strategy to look into it on a holistic manner. So I guess we need to try to filter out this noise, to know that when it comes to social media, a lot of things are simplified in order to catch your attention. A lot of things is basically for clickbaity. So it's just to draw eyeballs. So you need to differentiate that with real investment strategy, right? So then, of course, your news headlines. I think earlier we talked about that earlier, right? You've seen it, right? I think when I talk about the .com being .bomb, right? I think that whenever there's a bad news, the headline news becomes very, very scary at times. So even in a positive news, things are overhyped at times. For example, when Nvidia becomes the world's most valuable company, then people are starting to talk about, oh, when it will go to the next 5 trillion or 6 trillion or whatever, right? So it's always that when it's a rally, people talk about how much more it will go. And then whenever there's a collapse in the market, people emphasize and magnify the decline of the market. So you need to really allow yourself to read the news in order to obtain the information, but not be drawn in, especially on your emotion front, right? Then there's of course your peer pressure, especially when your friends are doubling their portfolio overnight. So for example, sometimes your friends, or even my friends, a lot of times they'll call and say, hey, I'm going to buy these stocks, I'm going to double, I'm going to invest more into this. This is going to be a real a game changer or whatever. So you always felt that peer pressure. So am I supposed to, if you don't buy and you miss out, then, you probably felt tempted to do so the next round. Then, of course, the recency bias. I guess this is very important to take note of, because the last 10 years, actually more than 10 years, slightly more than 10 years, the market has been really on a strong bull run. Even the short recession that we've seen during COVID, the sharp collapse, it actually recovered very quickly. So a lot of people are so used to buying the dip that we have not really experienced a prolonged period of recession, right? So just to give context, right, I think the global financial crisis in 2007, 2008 is one of the longest recession that we have, about 18 months, right? And the recovery period is even longer. It takes them about 3 to 4 years in order to recover back to its previous high. So in short, basically, of course, this is historically is proven that most markets do recover to their previous high at least in the next 4 to 5 years after the collapse. But there's always a certain period. So, but we have not experienced that for a long time, right? Since then, we have not really seen that because after the Fed cut their interest rate to a very low level, we have seen stock market to be on a strong run ever since then. So there might be that biasness in terms of being too confident with the buying the dip strategy. Then, of course, there's the loss aversion. I guess the fear of missing out sometimes outweighs the fear of actual losses. So people do tend to look at all the positive things, and then you will be driven by that greed in order to make money. So sometimes FOMO, actually not sometimes, most of the time, FOMO leads to irrational decisions. So it leads you to buying stocks at a high level and then selling it at a low level. Now, here's just a case study that we'll look at. I'm going to talk about Tesla from euphoria to exhaustion. So I think most latecomers into the Tesla stocks actually sold at a loss during the 2022 and 2023 panic period, right? Now, I'm not saying that Tesla is not a good stock, because I think if you look at the case for Tesla in a long-term basis, there might be potential given some of the given some of the business strategy that the company has. But I think there's a lot of execution risk with that, and there's a lot of uncertainties with Tesla, not just when it is struggling now from a political standpoint. I think we've talked about that for the longest time, right? Because of the valuation that Tesla has, that is at a very extreme level. So if you just look at this charts here, for example, in 2019 to 2021, share prices exploded. It shot up from like $10 all the way to close to 200, above 200 level. So you can see that there's that frenzy, because I think that's the time when people, your TikTok, your Robinhood, so all stocks, that are being highlighted by all these social media influencers or gurus have led the share price to go up in a very extreme level. And of course, Tesla is being marketed by Elon Musk, and a lot of people who invest in Tesla is because of Elon Musk. So there is that belief that he will deliver. So because he's not only the richest man in the world, he's brilliant, he's smart, a lot of that hype. So a lot of people overlook in terms of valuation, in terms of how much the companies are making in terms of earnings. So when you look at in 2022 to 2023, the stocks fell from its peak. You can see from here, it's mainly due to layoffs, delivery misses, and of course the Twitter overhang, because back then Tesla, Elon Musk decided to buy Twitter, right? So latecomers who actually bought at the hype of above 400 have actually lost a lot of money, and a lot of them have actually sold at a loss. right? And then if you look at in 2004 to 2025, well, there's also a volatile swing, mainly because Elon Musk's involvement in politics. I think at the start of the Trump's election, there's a lot of positive element on that for Tesla. But then when Elon Musk stepped down from Doge, and then there's a lot of uncertainties in terms of the relationship between Musk and President Trump. But overall, what I'm trying to point to you is that a lot of time when you look at the market, if you just look at based on the noise that are in the market, you will tend to buy at the high, because you'll be looking at the market when it's already get your attention, which is already after a certain incident or after a certain news that are being released into the market, right? So how do you manage this emotion, right? So I think it's very important, because I think if you look at the earlier, greed and fear are the key two reasons why investors make wrong mistakes. So this is just a look at on the right side charts. You can see this is basically the market cycle, right? So is in general is how it is. I mean, there can be a lot of different version of it, but the way I use it is this. So for example, when the market start to recover, right? Let's say you buy a stock at a low, and then when it start to recover, you felt that there's a bit of optimism, right? In this case, you are hopeful, you are more confident because things are looking good, right? So you think that maybe then I should invest more, right? Then this will lead to excitement as price continue to increase, especially if it meets your expectations, right? Problem is when it goes to an extreme high level, right, which is the euphoria market phase, where prices are trading at a very extreme valuation. That's when greed will come in, because you felt that the price will never come down, right? So this is going to the moon. So for example, people talk about Bitcoin today. A lot of people are very optimistic about crypto, which is, I have no personal preference on crypto, but I'm just saying that that the hype is there, right? So people are expecting it to go up, and you just can't miss out. So that's when FOMO really kicks in, right? But if let's say the market doesn't respond to what you think it is, for example, if it's really hit the peak and it start to go down, why I say if is because in reality, in reality, we will never know when it reached the peak of the market now. All right, on hindsight, it's very easy for us to see, but on a lifetime basis, on a real-time basis, we will not know. So it's only when the market fails to meet your expectation, when it start to come down, a lot of time when you already reached that euphoric level, when you're very greedy about your return, despite of a valuation that is a bit extreme, you will then be in denial. Basically, you will still feel that, you make the right decision. So you think that this is just temporary, the dip, so you're not going to be worried, right? But if it falls further, that's when fear starts to creep in, and then you start to feel anxiety. Then you start to question whether you should sell or not, right? So these are some of the emotions that will take place in. And then it's only when it drops further that you have panic, that you start to think, all right, I'm just going to sell everything, right? And then, of course, when it goes all the way further down, then that's when you go to a level that you just didn't want to invest in anything anymore, right? You just want to save, put your money into the banks. So that's where the extreme level where you call depression. But of course, it's a cycle. When then you see things start to recover, then that's when you start to have hope again, and it goes back to the optimism cycle, right? So again, this is things that we try to simplify it in a way for you to see. In reality, is that no one knows when you will reach this market cycle, right? Because if anybody knows, you already make a lot of money, right? But the idea is this: don't always chase the high. When you reach a certain level that you think, if the valuation is at a certain level that is a bit extreme, then it's possible to time for us to really rebalance our overall portfolio. Right, so some of the tools for you to stay grounded, to really manage these emotions that you have, is to really create a trade journal. Basically, this is to record the reasons why you invest in certain stocks, which is what we are doing in this ASEAN Investment Challenge, right? We ask you to list down your ideas. We ask you to list down your strategy. So this allows you to create a habit to start your own trade journal, right? So then you know the target price that you're looking at, the stop loss that you intend to have, and of course, the lessons that you learn throughout your trading and investment journey, right? Then, of course, before you decide to enter the trade, always preset an exit plan. Know when you intend to take profit and stop loss before you enter the trade, right? And of course, there is a walk away rule. Basically, there's a rule where you just know that, okay, if you're not making money, or that's the certain losses, then you will stop trading, right? You just exit your particular investment. So this, or even, for example, if your emotions are too high, if markets are going up at such an fast pace, then take a break, stop, right? Sell your take a profit, and then relook and re-strategize, right? Now, of course, there's basically this is in line with the next one, which is what we call position sizing strategy. So basically, never risk more than 2% of capital on a single trade. This is not to say that you invest 2% out of your the overall allocation in a single security. I'll explain this later when I talk about position sizing in a more detailed manner. Then there's also risk reward ratio. Always know what you're looking at in terms of the upside potential. So usually I look at it is about 2 times to 3 times of the downside risk that I'm managing, right? So that's how I look at my risk reward ratio, how much risk I'm taking and how much reward I'm looking at, right? Then of course, using the stop loss orders. So this will help to automatically limit your losses without emotional involvement. So by setting that in advance, you won't be forced to make that decision when the share price tank by 10% or 20%, right? Trading stops basically lock in some of the gains as price moves in your favor. This is to protect your downside, right? Okay, so build your defense plan. Why is this important? I think I'll give you an analogy later on because it's very important. A lot of people look at investing as offensive, right? Which is good in a way, but you need to really defend because that will keeps you in the game. So offense wins you the game, but defense keeps you in the game, right? So risk management is not just about avoiding losses. It's about ensuring that you can stay in the market long enough to benefit from the long-term growth and compounding. I think last week, we talked about the time in the market being more important than timing the market. The longer that you stay in the market, the higher the chance for you to win, right? So it's the same, right? So in order for you to stay in the game, you need to have a certain defensive strategy, right? So just to give a bit of differentiation, what is the offensive and defensive, and I talk about here. Those who are more offensive mindset is that people will try to look at stocks that are good, right? You're constantly searching for stock ideas, filtering for stock ideas, which are good behaviors, right? Then you look at the latest trends, the latest thematics, the best business to go into, right? And then of course you time your entry and all that when you want to go in. So all these are really a more offensive mindset because you are looking into buying the market into the market, and of course to maximizing your upside in general. For defensive is really to avoid overexposure. So you want to try to avoid just having all AI tech in your portfolio, for example, right? Or you don't want to just invest everything into oil and gas, right? Or then you need to know how to cut losses, right? And then of course to control your position size and to manage the downside risk. So I'll just give an example for avoiding overexposure. I think this was back in I can't remember the year because it was very early stage of my career when I was still working with one of the buy side in investment fund, right? So what they do back then was that I think the oil and gas sector was doing relatively well. So there was quite a bit of exposure in the oil and gas sector, right? So this is how your portfolio will work for you. When you invest in, say, example, initially you invest 20% in, let's say, your oil and gas sector, right? But if let's say the oil and gas sector, in terms of the value, increased by 50%, right? That 20% allocation would increase. So instead of just 20% of your overall portfolio, you will probably have about 30% of your overall portfolio, right? So that means your risk would have increased because you're exposing more in the oil and gas industry. So for someone who is more defensive minded, is that you will look at all this in order to make sure that there's no overexposure, whether it's in terms of asset classes, whether it's in terms of sector, or whether it's in terms of individual company names. Now, the key risk management tactics, basically, there are 7. You talk about diversification, position sizing, cash position. I'll talk about that later, right? So basically, there are 7 key risk management tactics that helps you not to chase all the hot tips of buying investment on the high side. So just to clarify, a lot of these strategies are more for short-term trading or for tactical strategy. What we call it is that basically you are not looking to just invest and hold it for long term. You're buying and trading, you're trading, you're buying and you're selling. So it's more suitable for your tournament, basically for this challenge, this ASEAN investment challenge, because it's until end of August, if I'm correct. So this allows you to have a bit more tactical strategy so that you can utilize, make use of this risk management to avoid exposure. Because if let's say you buy into a certain stock and then it suddenly drop by 30 or 50%, right? Then it's very difficult for you to regain back that position to compete in this challenge, right? So this is just some of which is why I'm addressing the short-term strategy before I talk about the longer-term risk management. So if investment were a football game, for those of you who are not football fans, sorry, because I'm one of them. So, but if investment were a football game, right? Italy would have been a better investor than Brazil because they are very good at defensive, and Mourinho would be better than Pep because again it's about defensive because defense lets you stay in the game and there's a chance to win. So someone who's more offensive are probably more on the left hand side, which talk about YOLO, basically your FOMO buys, your YOLO trades, speculative stocks. You want to buy into stuff like crypto. Basically, a lot of offensive strategies. You're always looking for stock that can give you multi-fold return, right? For someone who's more defensive, they're looking at diversification, position sizing. You want to have a certain cash reserve, there's stop losses, and a bit of long-term mindset. So the idea is really to defense. So this will help you to stay in the game in the longer term. Right. So the first one, let's talk about diversification. I think this is quite easy. I think most of us know about this. Sorry. So for diversification, it's not just in terms of the stocks, it's usually diversification across sector, the region, and also, of course, your asset classes. So, but because this challenge is focusing on stock market, but we do allow you to look into various markets, like, for example, the MIST Malaysia, the various local markets that you have, as well as Nasdaq. I think the Indonesia market, due to regulatory reasons, I think can only invest in the Indonesian market. But the idea is basically to teach you guys to not just put all eggs into one basket, so that you can reduce the impact if, let's say, an idea fails, right? So I'll just give you an example. So if you look at the dot-com bubble crashed at that point of time, right? There's a sharp decline, but the more than 50 to 70%, 50 to 80% decline, but it's mainly just in the tech sector. So if you buy everything in the tech sector at that period of time, then your portfolio will lose out a lot of money. So for example, just give an example, if AI stocks were to tank tomorrow, and if all your exposure is in AI stocks, then you have lost, say, 40% of it, if let's say that's how much it dropped, right? So because you're looking at the short-term trade, so it's very difficult for you to recover the amount of money in such a short period of time. In the longer term basis, yes, you might probably look at it differently, but that will be a different strategy altogether, right? So then if you look at ASEAN financial crisis, Asian financial crisis in 1997, 1998, so it's mainly decline in the region. I think Malaysia, Thailand, and Indonesia, these countries see a sharp decline in their stock market, right? Even Singapore also suffered quite a bit, but Singapore probably was the least affected in the region. But if you look at other markets, they're probably not as bad as in ASEAN at that point of time. Then, of course, you look at COVID-19, the crash was temporary, but you also realize that a lot of new business models actually benefited from the recovery, right? So like your Zoom, for example, Netflix, a lot of those that stay-at-home business that can continue to run, right? So those actually flourish at that point of time. So the rule of thumb is basically try not to have a single stock to conceive more than 10% of your entire portfolio. So if you have $10,000 for investing, right? Try not to have more than $1,000 in a particular stock lah. So that's basically just a general rule of thumb. Now, I talked about position sizing earlier, so I'm just going to elaborate a bit so that you understand what is it. Some of these are a bit more technical today, so it might be a bit longer and a bit more dry, but I hope that this will help you to understand how you can position or strategize your trades in the near term, right? So basically, small bets will add up. I think a lot of people have the idea that when you want to invest, if you think that, say, for example, you think, oh, Tesla has dropped a lot, I think I want to buy into it now because it will jump back, it will recover back, you will see a big jump to, next week or something. But if you go all in with 100% of your amount of money there, then if let's say your thesis were wrong, then you have lost, say, for example, if let's say it dropped by another 20%, then you have lost a huge chunk of your portfolio, right? So the idea is don't bet the farm on one single idea, size your positions, and then, of course, use formulas like 1 to 2% of your portfolio per trade. That's this 1 to 2% is basically the downside risk, how much you're willing to lose. So, for example, if you have $10,000, so the idea is that you should probably limit your losses to about $100 to $200 for each trade. So let's say, for example, if you look at the blue color slide here, you can see that if you invest $1,000 in, say, Tesla, right, that's 10% of your capital, right? So you will set a stop loss that reach no more than 200. So for example, if Tesla were to drop by 20%, then you will sell. So your 1,000 initial dollar will become $800. You lose out about $200, which is only about 2% of your portfolio. So this is basically what it means by 1 to 2% of the portfolio per trade in terms of the losses that you're willing to bear, right? This way you are controlling risk without under investing. So because you want to make sure that how you manage your risk is dependent on how much you're investing, right? So of course, I think for the challenge, you are starting off with a set of amount of money. Everyone gets the same, right? So it's different in a real life situation. For example, some of you might invest, say, 5,000 every quarter, right? So then your amount of investing will keep growing. So that's how you want to make sure that you're controlling your risk without under investing, that you continue to invest in the market, right? And then your risk is based on how much you are investing. So don't confuse risk per trade with position size, right? All right, cash is also a position. I think a lot of people look at cash as some people are either they hoard cash, or some people just don't save cash at all. So there's usually the extreme, right? Either you save a lot of cash in your bank, or you don't believe in cash at all. So the idea is really to have a balanced position, because if you invest everything in the stock market, then you don't have the flexibility to manage. So for example, if you have $10,000 to invest, if you put all the $10,000 into the market, right, you won't have the extra cash to actually buy on a bargain, say, for example, during the March 2020 COVID crash that we've seen, right? So cash also help to reduce that portfolio volatility, because cash is more or less fixed, right? So you won't see that drastic up and down. So you are able to manage your portfolio. So it's usually between 5 to 10% of cash within a portfolio. That's usually how funds started off. Of course, everyone have different risks and different preference, but the idea is that cash is also part of that. It should also be part of the position within your portfolio. Right, preset your stop before you invest. Basically, know your stop loss level before you enter a trade. So there are various types of stop, right? Some people, when they invest, think, correct, I'm just gonna wing it, right? Like it's like when you go to a bar, I'm just gonna wing it and see what happens at the bar or whatever. But when you're investing, you can't wing it. You need to have a set of strategy, because, like I said, if you don't set your stop level, right, your stop loss level, it's very difficult for you to do it by the time the market collapses by about 10 or 20%, because then you're no longer rational, because then you're driven by your fear, right, or your greed level. So you need to allow yourself to preset a certain stop level before you start your trading strategy, right? So there are a few types of losses which I'm going to address, right? For example, it's either percentage. This is the easy one. Stop losses at 8%, 10%, or 20%, or there is a technical stop. So it's a bit more technical, a bit more advanced traders will look at this, like they're looking at if it drop below 200-day moving average or certain key support levels from a technical perspective, right? So if you want to learn more about the technical parts, we will be having a webinar on that together with our technical analyst on the 8th of August, right? So then there's also the volatility stop, which is based on the average true range. Again, these are very technical stuff, right? So you probably need a bit of time to look into the trading strategies on technicals. So basically, the idea is that you set your stop loss earlier. So let's say if you buy 100 stocks at $100 with a 10% stop loss, if it drops to 90, you will sell. You will not hesitate to do so. You set it in advance. When it hit that level, you sell. All right. Now, the fifth one is basically using trading stops to protect your gains. So lock in profit as price rises. I think this is important. A lot of investors, when they see prices go up by 50%, they probably will want the price to jump up by another 50%. And when it did reach that 100% gain that they wanted to, they want another 100%. So that's always the tendency to shift. You know, your target is always a shifting target in a way, right? So that's a very dangerous thing to look at. So the idea is basically, one way to do it is to look at trailing stop 10% below peak. So let's say, example, if the stock jump up from 750 and then it hit, $75 and then it hit 150. So you will sell it if, let's say, it drop by about 10% to below 135. So this keeps you from holding your winners for too long, right? Because some people, when they buy a good stocks, they hesitate whenever they wanted to sell. Right, so these are very important, especially for the campaign challenge, because you're looking at a short period of time. So you want to make sure that you are not holding on to a winner that are no longer moving, right? So that's something to look into. Then, of course, for those who are more advanced, you probably want to look at hedging, right? So this is basically using some of the inverse ETFs or options to hedge against downside. I think this is probably not available on our asset investment challenge. So basically the idea is that if let's say you want to hedge the market, so you will probably buy something that is in the opposite direction. So if you are already invested in the US market, you can opt to look at buying the SDS, which is the 2x inverse ETF. Is basically if it moves in the opposite direction, you earn money out of it, but it's in a leveraged position, so it's 2x of it. So this is very important during high volatility period. But it's not suitable for everyone, but it's useful in turbulent times. So the last one, you have an exit plan before you enter, right? So the few questions to really ask is that what would make you cut your portfolio or cut these particular stocks, right? So what's your target price that you want to look at, the that I talked about earlier, and then what are the time horizon that you're looking at? So are you looking at investing in this stock during the entire 2 months of this campaign, or are you looking at investing it for just maybe the next 2 to 4 weeks or something like that? So you need to plan it out so that you know. So don't just think about when you want to buy a stock, right? Also consider when and why you need to sell it. This is important, especially for short-term traders or tactical strategies. Now, if you're investing in long term, then it will be a bit different. Then your rules are probably not as tight. You're probably not required to have such a stringent rules to your strategy, but you should still size it with diversification in mind. I think diversification is something that we all talk about, whether it's for short-term or long-term investors, right? So for core investing, usually it's about 5 to 15% per stock, which is very common, right? Depending on how much you trust into the stock, a particular stock. Some people do go up to 20 to 30%, right? So those are people that probably they understand the company very well, or they have a very strong conviction of the stock, or they're just higher risk in terms of their portfolio, right? So you need to limit your risk position as well. So for example, if you intend to buy into smaller cap stocks or the penny stocks or the volatile sectors, so you probably want to allocate it with a lower percentage. So if you look at long-term investors, the things that you look at are very different. You look at business fundamentals. You don't just look at the short-term price swings. In fact, a lot of long-term investors don't bother themselves too much with the short-term price movement, and often they hold for years, so they're usually right through the cycles, right? You've seen the cycle earlier, right? So they usually invest beyond 5, 10 years. They're looking at a longer term basis. So I'll just give you an example. Warren Buffett invested, one of the earliest stock that he bought into was Coca-Cola. So, and he has been holding it ever since. So one of the key things about Coca-Cola is that the margin is good. The price level is comfortable for a lot of people to buy, whether it's during a good times or bad time, right? And then if you look at the company has been growing the dividend over the last more than 50 years, actually. So they call it dividend king or aristocrat, I forget. So basically, they've been growing their dividend on a consistent basis. So it's not just giving out dividend, but it's also increasing the dividend on a yearly basis to their investors, rewarding their investors. So when you're looking at investing long-term basis, you are probably more focused on these things rather than the price movement of the stock. So stop losses are not typically used. Instead, a lot more focus on revaluation triggers. So for example, what changed with the business model, right? So example, I think I'll just bring back Tesla as an example. So in the past, I think Tesla has relied quite a bit on the government subsidy for their EV cars in US. I think there are still a lot of subsidies, not in US, but in other markets for Tesla as well. But the business model is definitely changing. So Tesla is trying to move away from that to robotaxi. So basically, they wanted to focus a lot more autonomous vehicle, and of course, the robotics that they've been talking about. So they've just launched the robotaxi services in some parts of US. Is basically a trial period that they're looking at. So if this were to materialize and allow them to scale, this will be a growth potential for the business, but not necessarily, because it depends on how it is being executed, right? So this is where the evaluation triggers will come in, because there's a fundamental change in the business model. So you need to relook at this and see if this is a business that will make sense, and then you track on the company's earnings on a quarter-to-quarter basis to see if what you believe in or your thesis is correct, right? So that's basically how you look at in the longer term basis. Then of course, the portfolio allocation caps, I think is usually, like I talk about, is about 10 to 15% max per stock. And then a lot of long-term investors look at volatility as an opportunity rather than trend. So for example, if let's say the share price were to drop about 10 to 20%, and if you look at the business model and you think it is still not going to change, right? And then if you talk about to management and the guidance that the provider, the direction, it remains the same, then a lot of long-term investors will probably buy more at that level. So because you are buying at a cheaper price. So this is what happens during the COVID crash when the market tanked. A lot of long-term investors who believes in certain stocks that actually buy more into certain stocks to build up their portfolio to take advantage of the bargain that is in the market. So basically, they use correction to add on to winners instead of just selling into fear, right? So that's really the key difference. Because if you look at the right-hand side here, you can see for short-term traders or tactical investors, it's really about protecting your capital first, right? So if there's a sharp decline in the market, you'll probably sell it first because you want to relook at your trading strategy. So there's a lot of more quick entries, more quick exits, a lot more trading. So you buy and sell more, a lot more activities, right? So you rely a lot more on technical analysts. And of course, a lot more catalysts from news, headwinds, and the latest announcements in terms of whether, for example, now the US is having their earnings season. So you look at a lot of all these things to really benefit on the positive news, and of course, to avoid some of the downside as well. So the risk mindset, now that you know the two difference, right? Some of the tactical strategies that you have, it's important to reframe your mindset from prediction to preparation. So instead of just thinking whether you will make losses or not, you prepare for it, because investors in the market for those who invest in the long term, long enough, will know that the market cycle, the downtrend will definitely come. It's not if, it's definitely will come. It's a question of when, right? So it focus less on being right and more about limiting the damage whenever the market goes south, right? So if you ask yourself that question before you invest, is what if you make a wrong mistakes, right? So for example, now if you wanted to invest in Tesla, ask yourself the question: what if your decisions were wrong? What if your forecast is wrong, right? What's going to happen? So if you're only investing about 10%, then that's only how much you're going to lose out of it, right? But if you're putting in like 50%, then the risk has significantly increased. So that's how you want to position your stock. If you have a high risk stocks in your selection, then you probably want to allocate a certain percentage into companies that give you a bit more defensive, that are a bit more stable, like Coca-Cola or your P&G or Costco. So things that are a bit more different from the high risk stocks that you're looking into. Right, think like a business owner, not like a gambler, right? Before every investment decision, ask what's your downside, what's the worst case scenario, how long you can hold. If the stock were to drop 20 to 30%, would you buy more or would you be forced to sell, right? So these are things that you wanted to look into. So it's not that, it's not that, because I think, like I said, it's not a question of whether the market will see a decline. It's the question of when, right? So that's something that you need to pay attention to. Right. So if you look at risk mindset across timeframes, it's also different. Like I say, short-term traders focus a lot on trends, focus a lot on protecting capital. Long-term investors, in terms of the risk, is probably looking at building, compounding their wealth over time. So short-term is between days to months. Long-term is looking at years to decades. So I think I talked about this earlier. I guess I can just cut through this. Right. So a real example, I'm just going to bring back Tesla. Hope is not a strategy. Risk awareness is. So I'm just going to give you an example. If you're investor A and you buy Tesla for a 6-month swing trade, right? So you probably wanted to use a stop loss at about 10 to 15%. And the trailing stop once is increased by 25%. Meaning once you see a share price have gone up by about 20 to 25%, you probably wanted to set a certain trailing loss stop to that. For investor B, if you're buying Tesla for long term, for 10 years period of time, you don't really look at all these stop losses, or you don't look at the market swing, but you monitor a lot more the fundamental change, like how much market share Tesla has in the autonomous vehicle, for example. You look at earnings, you look at how much they can scale their business, and then you look at their CEO credibility. I think it's important to know, especially when the Elon Musk is also involved in some politics and stuff like that. So those are some of the key risks that you probably have to take note of as well. So these are basically the different risk mindset, right? If you're really trading, you don't look so much at some of the fundamentals. You look a lot more at the swing in the share prices and some of the news or factors that are driving the short-term movement of the share price. So both have different plans. Both are valid, but it has to be aligned with the strategy that you have. So for AIC, due to the short period of time for the campaign, I think participants will probably need to adopt a more tactical and trading approach to that. Right. So bonus round, like I did last week, I'm just going to talk a bit on the market. Let me just take a quick look if there are questions. Okay. All right. I'm just going to focus on the US market today because I think the US market has currently releasing their earnings result. Actually, a lot of the companies have released pretty decent good results. I think Tesla is an exception. Tesla reported quite a bad earnings, and then I think Elon Musk in his guidance also said that there's a potential for Tesla to continue to struggle in terms of earnings over the next 2 to 3 quarters. Another company used to be a very strong company, Intel. They also reported earnings. Their earnings is better than expectations, but guidance was quite weak. So there's a lot of fear factor on that front. So you've seen a share price came down quite a bit in the market for Intel after the announcement. Right. So just a bit of updates. So these are basically some of the strategies to look at. So they are the AI tailwinds. Some of the good news for those who are investing in the AI space. US, I think under Trump's AI action plans, intend to drive US tech competitiveness through deregulation, relax export controls, permitting reform, and of course support for advanced manufacturing. So you can see Nvidia share price was jump quite quickly last week. So I think yeah, because part of the reasons was because they can actually continue the export of their H20 chips to China. So that's one of the good news for Nvidia. And then, of course, in US, over 100 billion in financing is unlocked via the Export-Import Bank of the United States and the US International Development Financial Corporation, basically to boost the semicon software and AI infrastructure exports. So you probably need to look at all this news in order for you to make a certain decision when it comes to trading. For example, the cryptos in the crypto space, not those who are related to crypto market has actually jumped up because US actually passed some of the I think it's called the Genius Act or something like that. It's related to the crypto basically, right? On the stable coin market. Now, key beneficiaries in some of these tailwind includes your Nvidia Corporation, AMD, Microsoft, Meta platforms, Alphabet, cybersecurity platforms, and AI-enabled cloud service providers. So what's priced in? If you look at the market, there is a strong recovery since April after Liberation Day. After the sharp decline in the market, this is really because of the soft landing and optimism. People believe that economy is stronger to handle the potential tariff threats that Trump has talked about. And of course, the stronger economic data that support some of these thesis. And of course, the AI-driven inflows. But this has come with narrow market leadership. What this means is that there's a lot of crowding in high-tech stocks. So only selected companies that actually do very well. So the risk going forward really is the surprise in terms of inflation resurgence. So we have seen inflation slow down quite a bit over the last few months. So there is a concern if, let's say, tariffs were to kick in and we to see more of this inflation would actually creep up and then hurt the economy. Then, of course, the volatility shock. This is basically looking at the wicks. I will explain what wicks is later. So if there's a spike in the wicks, then the market might be a bit more fearful. So this might lead to some correction. And of course, some geopolitical or policy disruption. I think just not sure it's today or this week. I think it's this week. There's Cambodia and Thailand were potentially going to get into another conflict in the world, right? So there's something to pay attention to, how it will affect the market. Because prior to that news, the stock exchange of Thailand actually recovered quite strongly over the last week. But then I think today the market has actually come back down a bit. So a lot of the rally that we've seen is built on momentum. So we do need to look for fatigue. There is a concern in terms of, people are probably a bit worried in terms of what happens if there's a bad news that come up, right? So some trigger watch list to look at when you look at this. This is basically things for you to look at in terms of whether there will be a pullback in the market. So look at if, let's say, you see there is an oil or gold rebound. If you see that oil or gold increase, then this might actually affect some of the market. Credit spreads widen. I'll explain what credit spread widen is later for those who do not know. And of course, wick spike as well. And then, of course, a weak market breadth or tech earnings disappointment. So weak market breadth, basically, if you see across the market, you see a lot of weakness, especially when it comes to earnings. If there's a lot of disappointment, then you probably want to shift some of your strategy, right? So what is credit spread? So basically credit spread is the difference in yield between risky corporate bonds and safe government bonds. Wait. Okay, if you do not know what bond is, basically is when I want to borrow money from investors. So what I do is that I sell you bond, right? So when you buy my bond, I will give you a certain interest every maybe 6 months or quarterly or 1 year. So that yield, that interest rate, or that's what you call yield in bonds. It depends on whether you are a risky corporate bonds or you are not risky, right? A company with good ratings will have lower yield, meaning they don't have to pay interest so much in order to get borrowings. So in this case, if you look at risky corporate bonds, you will see that the yield is higher, while safe government bonds like the US Treasuries, people don't think that the US will go bankrupt, right? So it's safe. So the yield is lower, right? So this difference, in terms of the yield between the risky corporate bonds and the safe government bonds are basically the credit spread. So this tells us how much extra return that an investor would demand for when you take on a certain risk, right? So why is this important? Because when you see the spread increase, meaning that the yield for corporate bonds and the yield for safe bond, when the gap widens, that means that investors are more nervous. They are more afraid of what's going to happen to the economy. That's when risk is increasing. So basically, that's bad for the stocks. So when you see a widening spread, usually it's negative for the stock. So when the gap were to narrow, right? So then investors tend to be more confident. That's why your yield gap is narrow. People are not demanding so much interest rate differential in order to take on the extra risk, right? So it's basically good for stocks. So how do you see this widening spread or narrowing spread? One way to look at it is look at your ETF. So what you need to do is you go to Google and then you search HYG and IEF. HYG is looking at the high yield corporate bonds, while IEF is looking at the 7 to 10 years US Treasury bonds, which is safer. So when the price goes up, so for the HYG, basically for bonds, right, when your price goes in a different direction with your yield. When your yield increase, your price decrease. So when your price goes up, meaning your yield come down. So basically when your yield come down, like your higher risk yield came down, the market is a bit more positive. So it goes vice versa, right? So how you look at when the gap is when the credit spread is widening is when your high yield bond, then when the price came down and the price for your US Treasury bonds goes up. So that's how you know that it is the credit spread is widening. There's a lot more risk, so it's bad for the stock. But if your high yield corporate bonds price goes up and your US Treasury bonds are either flat or decline, basically it's actually good for the stock because your gap, the yield differences would have narrowed. So that's basically how you look at the credit spread. So you probably need to look at the charts again to understand it clearly, so that then you can see when the risks are increasing for a lot of institutional investors. Now, what is WIX? WIX are volatility index. Basically, it means the fear index. So when people want to know when the market is afraid or fearful or greedy, they look at the WIX, right? It basically tracks the market volatility, how volatile the market is. So how they look at it is that if let's say the WIX is low, usually below 13, then the market is calm. If it's high, say above 20, then it's risky, right? So how you're going to look at it is you just Google it on your stock app. And then when you see that the WIX are increasing, then it means that investors are becoming more nervous, right? Not necessarily look at the 13 or 20 level, just look at the movement of the WIX itself. If you see the WIX continue to go up, it shows that investors are a bit more fearful, right? So that's when you know that it's probably time to reduce some of the risk. So the strategic allocation for second half. So if you look at this, it's a lot about rotating your stocks rather than selling off everything, right? Because defense is important, especially when your offense is stretched. What it means is that when, say, example, we've seen over the last 3 months, the market has been on a strong recovery rebound. I think the S&P 500 is trading at an extreme, not at an extreme level, but it's trading at an expensive level. It's about at around the 10-year historical average level. So it's quite expensive in that sense. So there's a lot of positivity that's priced into the market already. So you need to be a bit more careful in your allocation. So one way to look at it is, if you look at the suggested allocation, is basically try to allocate about, if you want to win the contest, then you need some growth. So maybe you can put overall about 40% on growth stocks, 20% on those that give you moderate growth stock, like your cybersecurity or infrastructure. Infrastructure means your constructions and all that, right? Then about 15% on the more dividend and defensive stocks. And then, of course, a bit more, around 10% on speculative, to try to gain that up higher percentage over your peers in the competition. So that's basically some of the strategy that you can apply to it. So these are just some of the names that we shared across based on some of our research partners in US. So these are some of the names that we are sharing with you guys. Okay, I think that's it. Wait, I think there is a question on, given the current landscape, taking consideration from geopolitical tension, is it safe to invest or should we save it? Right. I think the right answer is that you should stay invested, because like I said, it's always, investing is not timing the market, it's about staying invested in the market. But I do agree that because of the rising uncertainty in the market, you should lock in some of your profit, especially if you look at the market over the first half of the year, right? The global stock market has actually seen a strong rally. Hong Kong and the South Korean market is the best performing market. Singapore is one of the best performing market in ASEAN region. US has also recovered quite significantly after the decline in April. Then if you look at Europe, they are also doing very well. So in short, the market has done very well in the first half, which is a positive signal, right? But I'm not asking you to sell off everything. I'm just asking you to take some of the profit, lock some of the gains that you have made in the first half, and then we look at the portfolio once you see a bit more stability in terms of the trade deals that the US is doing with China and the rest of the world. And then from then, you make your decision based on what are the latest updates coming from the earnings and all the other news. What products or asset class, which markets should I invest in? I think it's quite subjective on this question. Personally, I think if you are, depends on how old you are, depends on how much money you have, depends on your goal, right? If you're very young and you just started out, then I think stock market is something that you should start off with, because you have the time, you have the patience to go through, right? The different various cycles in the market. But if you are someone who's older, then you probably wanted to allocate your position to have a bit some safety in asset classes like the bond market, for example. So yeah, so that really depends on which what's your age group, and as well as your time horizon that you have planned for your investment, right? So I think that's it, and I don't have anything else. I guess that's it for today's session. If you have any questions, just feel free to just send your questions to us on, I think, and our team will respond to you. So just wanted to clarify again, right? I think when I talk about earlier when I said some of the risk strategy that we talk about today, a lot of it focus on the um on the short-term trading, because the ASEAN Investment Challenge is only a 2 to 3 months period time, right? So you need to be able to be more tactical in your trading strategy. So for longer term investors, your risk management will be very much different from those who are on a short-term basis. All right, I think that's it.